Rick Lacaille, Global Chief Investment Officer from State Street Global Advisors, joins us in the studio now.
Hi.
Good to see you again, Rick. So what are you buying right now?
Well, we have a little bit of risk in our portfolios from a top-down perspective, but probably a little bit less than the long-term average because there's quite a lot of economic uncertainty. You could say there's always economic uncertainty. But with the market expecting quantitative easing in the US, with intervention in the yen, there's a lot of interventions and potential surprises out there. So we're taking a little bit less risk than normal. But we still do have a risk trade on. So we're still a little bit overweight in equities, a little bit overweight in credit, overweight in large cap against small cap, and we still have a small overweight in emerging markets. So a bit of risk on the table, but not an enormous amount.
And in terms of country weightings, how does Europe, North America, emerging markets, how do they compare?
Core Europe looks quite attractive from valuation grounds, and momentum and sentiment are pretty good as well. So some of the core European countries, Germany, Denmark, Austria, some of those countries look pretty good on a ranking model. Some of the Far East, some of the smaller, faster-growing Asian markets like Singapore also look attractive. Japan looks quite attractive, but again, because of economic uncertainty, there's a little bit less certainty about our forecasts in Japan, perhaps in some other markets.
I mean, as the developing world grows much faster than developed markets, we've been speaking about this all morning, should investors really be looking outside of mature markets, outside of the US and Europe right now?
Well, I think that's a long-term play, but a lot of the valuation discounts gone. I mean, we're used to having a valuation discount for emerging markets, and we're used to having less correlation between emerging markets and developed. Both of those changed in the last several years, and right now the valuation discount really isn't there. However, the growth potential seems to be much better, both in the short term and the long term, and that's one of the reasons why a little bit of positioning in emerging markets still makes sense for us.
So talk to me about your major holdings.
Well, we're generally, within our asset allocation portfolios, indexed. So we take a top-down view. We allocate our risk budget across credit, equities, at the regional level and at the country level. Within stock-picking portfolios, we tend to be quantitative investors for equities, and we tend to favour things that are cheap, obviously with some improving prospects. And that's really very sector-neutral.
So no specific industries that you're focusing on at the moment?
Yeah, we tend to eliminate where we can those industry bets. Now, that can change over time, but generally we try to eliminate those industry bets and stick to stock picking.
Why is that?
Well, industry bets can be affected by macroeconomic surprises, and to some extent those are predictable, not surprises, but the environment's certainly predictable, and positioning in and out of industries makes sense. But in terms of our risk budgeting, it makes more sense to focus on stock picking than it does for industries.
Now, at the moment, we're seeing protests right across Europe in 12 countries, ongoing obstacles, ongoing opposition to austerity measures. What are you thinking? What are your expectations in terms of growth for Europe and the US?
Well, I think many of the periphery governments have done a great job in addressing the market concerns. They've made announcements, they've made plans. I think the execution is the real test. And as you see social protests beginning to emerge, that's going to be a big test for governments. Will it crimp growth? Inevitably, you'll have some growth discount as a result of some of those austerity measures. But I think if they need to keep focusing on fiscal discipline in order to get financing costs down, because markets are still very jittery. And you've got this incredible flight to quality that's tangled up to some extent with quantitative easing.
And when we speak about quantitative easing, austerity measures in Europe, we've had weak consumer confidence figures in the US, joblessness, unemployment still a huge problem on both sides of the Atlantic. Is deflation a major concern for you right now?
I wouldn't say deflation is. And again, you've got a very different pattern between Europe and the US now on things like quantitative easing, where I think the market's expectation of quantitative easing is much more profound in the US, to the extent where it's a bit of a danger for the market. People are building a little bit too much in, and that's crushing yields in the US, both real and break-evens. Whereas in Europe, I think you've got certainly a rhetoric that says that it's going to be unwinding, and that they're going to rely on governments to fulfill their austerity pledges to kind of keep the show on the road. Now, you asked about deflation. There is no sign clearly of inflation, but we're not expecting deflation. We're not in the double dip camp. We're expecting weak growth and some degree of price inflation, but not negative.
Rick Lacaille, Global Chief Investment Officer for State Street Global Advisors. Good to talk to you. Thanks very much.